Welcome to the Financial Beast Podcast, the practice owner's guide to maximize practice value and create personal financial success. Your host, Eric Miller, is the co-owner and chief advisor at Econologics Financial Advisors. He is also a national speaker and published author in financial matters focused on practice owners at every phase of ownership.
Well, welcome everyone to the Financial Beast Podcast. This is where we show private practice owners how to, uncover, recover, discover practice profits, and then turn that into personal wealth for your households. I'm Eric Miller, Chief Advisor and co-owner of Econologics Financial Advisors, and I am here with
Eric Gersch, Financial Advisor here at Econologics.
There we go. All right. So, what's been happening lately?
A lot.
Yes.
Inflation. I
guess that's the buzzword today.
Yep.
So to look at this, I'm looking at some of the year-to-date numbers right now. The Dow is down 19%.
Yeah, the S&P is close to it. I think it's about 21% actually.
S&P 500 is down 23.39%. And the NASDAQ, if you've been so lucky to invest in that, is down 31.8%.
About a third.
Cryptocurrency has lost over $3 trillion of wealth in the last, seems like 6 hours. So there's a bunch of good news going on right now.
Yeah, great.
And, I think from our part, we try to impress on to people like, look, you really can't control what's going on the outside economy, but you can control what you're doing internally.
Agree.
And, one of the things that we hear a lot of right now is this inflation. And the basic of inflation has always been to me is like, if there's more money that's in circulation versus the amount of production that's occurring, you're going to get a rise in prices. And that's exactly what's happened. Go figure. When they unloaded trillions of dollars, what that was back in like 2020.
Yeah, 2020, 2021, stimulus, PPPs.
All that money finally got into circulation.
And now we're paying for it.
So I got to wonder if it was worth it.
That's a good question. And I've actually been thinking about that the last couple of days. On one end,
did you come to a conclusion on that or what?
On one end, I look at the PPP. Okay.
Yep.
That had a defined purpose that genuinely helped a lot of our clients.
True.
On the other end, you had stimulus checks to individuals where, yeah, I'm sure it helped millions of people, but there were also millions and millions of people who really didn't need it. And all that extra money propped up the economy through 2020, through 2021. And now we're paying for it.
So this
today.
Is the unintended consequences that you tend to see when you start just doling out money.
Unintended, but predictable.
So now the reality is that, if you own a private practice, not only is it hard to find people nowadays, which I think is going to be a temporary thing. I think it's going to be a temporary thing.
Yeah.
So in your role as an advisor, you hear a lot of clients talk.
Every day.
Right. And I'm assuming the workforce problems are one of the bigger issues that most people are talking about right now.
Oh, almost every single client, every single state, urban, rural, everybody is having issues finding staff, keeping staff.
Keeping staff.
Yep.
Yeah. And there's really no rhyme or reason why. Life happens. People either they move to another job, or most people go into other jobs. Is that what's happening? Or are they just not there?
It's a mixed bag, but I think by and large, the majority is people just job hopping here to there, to there, to there. And, by the time you hire someone, you put money into training them, you get them fully, hatted,
Yep.
and then they move on, that costs businesses a lot of money.
It does cost a lot of money, and it's depressing too.
Yeah,
Because
it's soul crushing. I mean, when I talk to clients, not, this isn't every client, but a lot of clients who have sold have said one of their top motivators was just burnout from all of the HR, the nonstop.
Yep. Yeah, that's going to happen. It's one of those things where if you're going to have an organization, you're going to have people. And that is, everyone's different. Every individual is different. And, people move on, they want to do different things. And unfortunately, I think that, what we kind of see coming down the pike right now is, inflation is going to hit, it already has hit private practice owners, especially in wages.
Yes.
Because now it's more expensive to hire people than before. And I don't know if the production has actually caught up with the rise of wages. Not only that, but cost of goods sold have to be going up as well.
Yeah, I was actually took a look at this with a couple clients, and wages on average have gone up about 18% since 2020.
And it's not just wages, it's the benefits that go along with that as well. Health insurance,
Of course.
and everything else that goes along with that. So I think it's more imperative than ever right now that you really look at, revenue per employee, as a statistic, because if that gets out of whack, especially in a private practice, you're dead. And,
Absolutely.
And I think this is what happened 2 years ago. People started to see like, wow, maybe I don't need 3 people to do one job. And I don't know when that's going to hit, but at some point in time, profits are going to get squeezed low enough where I think that's going to be a phenomenon that occurs.
Yeah, I've seen that in a number of cases. You look at people's, say you look at 2021, right? Most recent full year. And sure, their revenue might have grown 8, 10, 12%.
Yep.
But then you look at their expenses, and their expenses are up 18%. You're not really growing at that point.
You're not
I think
getting ahead.
The demand for growth, not that it's not always there, but you need to be growing at, I guess, a higher percentage right now than you needed to a couple of years ago just to stay the course.
So if we look at that, then what is the growth rate that a company needs to target then every single year so that they can keep up with that? Because we may need to change some of the numbers that we talk about.
Yeah, for targets this year for a make break, which, as our clients probably know, the make break is not make break in the sense of keeping the doors open. It's make break in the sense of staying viable, being able to save your 10%, pay your operating expenses, taxes, so on and so forth. But anyways, I've been setting the make break for clients between 10 and 15% growth this year, because if inflation's going to be another 8, 9%,
Yep.
that's just squeezing out probably a real 5% growth at most.
So 10 to 15% per year
Minimum.
is what you need to be growing at right now.
Minimum.
Yeah. So then you look at like a 3-year rolling rate, then what would that equate to? So that would be, if you really look at that, that's probably closer to 45 to 50%.
Yeah.
Over that period of time that you need to target to grow.
Yeah, I think that's fair.
Which is actually more than what we have as one of our metrics. The beast mode metric, I think we have it like 25 or 30%.
Yeah,
So
it's 25%.
Probably need to we probably need to adjust that, because the reality is these expenses are going to get higher, and it's going to then start squeezing into what you're able to take home for the benefit of your household, and it's going to impede your progress personally to create other income sources, to get out of debt, to do all the things that you should be able to have the business allow you to do and provide for you. So it's actually even worth the heartache and hardship of owning it.
Of course, yeah.
So, okay, number one, the way to fight inflation is to recognize what your numbers need to be in order for you to overcome its effects.
Yeah, recognize and outgrow it.
Yeah. So that's point number one, is the recognition of, okay, so while I was told, because, I hear a lot of, especially in some of these different fields, PT, dentistry, veterinarian, optometry, if they're growing at 5 to 8%, that seems to be good. And it's like, nope, you're barely going to be getting by.
Yeah, that might have been sustainable when inflation was 2.5%.
Exactly. Yeah.
Not today.
Not today. So your growth rate needs to exceed 12 to 15% a year.
Yeah, I think that's fair.
Just to keep up with that. So that's point number one, is recognition of what your numbers need to be to do that. So then, that of course leads into, all right, so if that's the case, what do I do next? Well,
tell me.
I don't know. I was kind of hoping you'd say something right there.
Not sure where you're going with this.
No, I don't know. I mean, I think we're looking at like how to fight inflation. That's number one, I think is you have to have the recognition of the right number of what you need to grow at. Right.
Yeah. And I think a good number two then to add on to that would be know where to spend your money.
Oh, that's good. Okay. Yeah. Because if you're going to, you have to be more mindful of the outlay of money and where it's going. Okay. And, of course that means that you have to keep all of your metrics, all of your practice metrics in alignment. Like you can't overspend. You have to be more mindful of your inventory. You have to be more mindful of your benefits and expenses. You have to be more mindful of all these things. So, but you also have to make sure that the money that you're outlaying is actually producing something and allowing you to grow.
Yeah, I think a big one to add on to that is, you see your wages going up, your cost of goods going up, and what do you start doing? You start trying to reduce your spending, and sometimes that bleeds over into your marketing.
Yep.
Which now you're just killing your new patients.
Yeah, you really have to be mindful right now that, and in most of the industries that we're in right now, I haven't really heard a problem of getting new patients.
No, not really. No.
I mean, this is like the first time where it hasn't seemingly been. Right now, if anything else, it's like, I don't have enough staff to handle all the people.
Yeah.
Either way, it's bad because there's a mountain of lost income that is being created because of that. So if whether or not you have you don't have enough patients, but you have the capacity to see them space-wise, or you have too many patients, but you don't have the employee capacity to see them, it's still the same thing.
Yep.
It's still services that aren't being delivered that could be, and that's creating a mountain of lost income.
Yeah, it's your biggest expense.
I would say that it is your biggest expense by far. By far, it's your biggest expense. Is the gap between what you could be making, your capacity, and what you are making right now, which is, whatever that is. Yeah. So I think that's that's something that you need to take a good hard look at. And of course, everyone's like, well, I don't know. I don't know how to fix that. Well, all right. Well, I don't either, but I mean, there's got to be something you can do, I'm sure. But I think that it is a very important point, is that looking at what your capacity is compared to where you are right now and what you could be doing, and making sure then that you're spending money on things that are going to help reduce that.
Yeah, get you closer and closer.
Get you closer to that
figure.
So, what does that mean? I don't know. More recruiting. I mean, there's only so many bonuses that you can give to people to try to incentivize them to work there.
Yeah.
So for me, it would be like, I think you got to do a lot more marketing of your practice as a really nice place to work. It's a good place to work. It's a fun environment. People are treated well. Things are, you're achieving, they're purposeful, you're growing. I mean, I think these are some things that you could spend money on, like upgrade your public relations.
Yeah, it needs to be an enjoyable place to work, a good environment. And then I think the other piece of that too is you need to reward production.
Yeah.
You need to pay bonuses to those employees who are working so hard to drive your practice. And that will, hopefully it should at least bleed over into retention. Because if an employee is happy when they come in each day, if they feel like they're being fairly compensated for how hard they're working,
Yep.
they're not likely to leave.
No, I think the last survey I saw, the majority of reasons why people leave were compensation was number one. Number two was lack of a career path. Like there was no future.
Yeah, that's probably a big one.
Right.
That makes sense.
And then the third one was lack of recognition. Like not acknowledging someone for doing something.
Yep.
All three of those things are relatively fixable.
Oh, absolutely.
You know, without having to like break the bank. Look, the small practices are not going to be able to compete with corporate on salaries.
No.
You know, or bonuses. You're not going to be able to compete with them. You can compete with them when it comes to creating a future path for someone, showing them that, look, you do this, this, and this, then you can actually, rise in the organization to get to this position. And then acknowledging somebody is not that hard to do. All you have
that's
to,
the easiest.
Is just say, hey, you know what? I mean, you did a really good job. Thanks for that. Let everybody know. It could be a gift card. It could be, hey, here's a day at the spa.
Yeah.
Here's go get a manicure or pedicure.
Yeah. Something simple.
Do you need a pedicure?
I do not.
You ever had a pedicure?
Actually, no. Have you?
I've had a pedicure before.
Okay.
I'm not ashamed to admit that we've had that before. Maybe you ought to get one.
You shouldn't be.
I'm not. It's actually, they're refreshing. You should get one. Anyway, but I think the point is that you can acknowledge people in a number of different ways, and it doesn't necessarily have to be like, all right,
It doesn't have to be thousands of dollars.
No, it's pretty simple. So those are some things that you can control in the practice to make sure that you keep your people. And then again, I think that's an important hedge, to help fight inflation, because if you don't have people to do the work, then your production's never going to be where it should be.
Yep.
So that's another thing. What else can you do to fight inflation? So be mindful of expenses, certainly promoting your practice more, the good work, so you can attract good people. Again, I'm still pretty convinced that even though it's hard to find people right now, if we're going on the same trek that we're going right now, I don't think it's going to be hard in 6 months and 8 months. Because if we really experience a downturn or recession, then that should increase unemployment.
Yeah,
and some of these businesses just can't afford.
Yeah, it'll be a quick snap back to reality.
Yeah,
per se.
Yeah, where it will be a little easier to attract good people. So, other things you can do to fight inflation. I think on the household side, certainly, we talk a lot about making sure that you are, not losing money is always a good idea, right? When it comes to fighting inflation.
Yeah.
And the reason I say that is because I've had some clients here that have all of a sudden, 2-3 years ago, all they talked about was, this investment's getting me this yield, this investment's getting me this yield, this investment's getting me this yield, but they never really took a look at the investment.
Yeah.
And now
it's cyclical.
Yeah. And now I've had one real estate company that's now going bankrupt that I know some people put some money into, and they never inspected the actual company at all.
Really?
All they did was look at, hey, I negotiated a 10 to 15% return from this company. They thought they did such a magnificent job.
And never looked at the underlying financials.
Didn't look at the kind of real estate they were buying. Probably didn't ask the questions about how leveraged they were. Probably didn't ask the question of what your expertise is in this area, and now the company's going bankrupt.
Yeah, when times are good, people just see. I mean, from 2009 to 2022, basically.
Yep.
Everything just grew every single year. Real estate grew, stocks grew, bonds grew, Bitcoin grew.
Yep.
I mean, there was no real reality check for a decade. And I think that made people think that this is the new normal.
It's like whatever they put their money in is not destructible at all. Like they're always going to get their money back without doing really any due diligence. So if anything else, I hope it really shows people how to be a little bit more prudent when selecting investments and not just, run to something that's going to produce yield and not really inspecting anything over and above that. So it's a good opportunity right now to kind of look at your portfolio and make sure that you know what you own.
Yep.
With
that said, let me ask you something.
Mm-hmm.
What do you think people should be investing in right now?
Well, that's a good question right now. Well, look, for me, especially the type of clients that we have, I think number one, you have to be putting money back into your practice towards things that are going to allow it to grow, because that is the thing that's going to help you fight inflation more than anything else. Like if you look at a household portfolio, like everybody tell me if you've heard this. I don't want to keep money in the bank because it's not keeping up with inflation.
Yep, every week.
Or if you hear someone that's invested in like an annuity or something like that, but it's not keeping up with inflation. It's not keeping up with inflation. It's not keeping up with inflation. Not all of your investments need to keep up with inflation.
No, you have to have that safe base.
Exactly. So you can say that like, well, I have, this money is just getting eaten away in inflation. I'm like, well, you know what? You're not looking at your household as a whole then. Because yes, you are going to have investments like your practice that should be, providing more than enough income. Okay. That is riskier. That should more than beat the inflation rate.
Absolutely. Yeah.
By double or triple.
Oh yeah. I always go back to when people's, when we get into this conversation and the practice, I always go back to, what multiple does your industry sell practices at? Let's just say it's a 6 multiple.
Yep.
That means that every dollar you increase your earnings by, you're getting a 600% return on that.
Yes.
So if you have 10% of your money in investments that are only growing at, say, 3 to 5%, and your practice makes up 60% of your household, and the return on those dollars is 600%, it all averages out to a pretty darn good rate of return.
Yeah, it should.
Not everything has to swing for the fences.
Exactly. You're going to have some investments that are there to preserve and be able to, if you need leverage against them for some reason. So this idea, and this is risk management, of course, this is what people never want to do, which is risk management of a household, right? It's like, what are my investments doing? They don't really think about anything else.
Nope.
To your detriment. It's to your detriment for you to have that mindset. So you have to look and say, okay, what are my investments that are designed to really exceed the inflation rate? Okay. And then I'm going to have some investments that are there for other purposes, for liquidity, for income, for safety, right? They're just not all going to have the same, they're not going to have the same designation of, I have to beat inflation. Yeah. As a household, you need to beat inflation.
Of course.
But not every one of your investments.
Not every single dollar needs to beat inflation.
Exactly. So I think to answer your first question, I would definitely allocate, especially in the industries that we're in right now, because the multiples are there.
Yeah.
The values of these practices are much more valuable than they were even 5 years ago or 7 years ago.
Oh, by far.
So I would reinvest back into either, adding capacity. I would reinvest back into trying to really go out and find people so that you can deliver to your capacity. I think that's a great place to invest money. Another great place to invest money, I think, is looking at how I can save in taxes, and looking at tax strategies.
Yeah, dollar saved is as good as a dollar earned.
Because that is it's a pretty big expense as well. And investing in tax strategist or, strategies that will allow you to keep more of your money, I think is a great way to hedge against inflation as well. And then, do I think, putting money in, right now, real estate and all those areas is a good hedge against inflation? Sure, I do. But it just can't be the only investment that you look at. I mean, right now, stocks are on sale.
Yeah.
And if you're looking at good quality investments that you can get on sale, I think that would be the approach to have. Yeah. Not just going out there and blindly buying, just companies just because you heard that they're good. I think, good quality companies at a low cost. When has anybody ever lost money doing that?
Very seldomly, if ever.
Exactly. So I think the premise is if I'm gonna invest in things, number one, I want to know what I invest in.
Yep. Okay.
And that goes for people investing in annuities and cash value life insurance and all these things as well.
Oh,
just know what they are and what their purpose is.
Yeah.
I'm pretty proud that we've never gotten boxed into any one type of investment.
Yeah, no, we really do the whole spectrum.
We think that, I want people to invest back in their practice, which most advisors will never tell you to do because that takes away money from them. Number two, to put money into certainly equities and fixed income securities, wealth management, but do it intelligently. Never have it as like 50% of your overall household portfolio. We try to keep it in a range, I think, of right around 25 to 30% of your overall household portfolio that you would keep in wealth management, traditional wealth management. Utilization of insurance and annuity products to hedge and provide guaranteed and lifetime income. Nobody talks about that anymore. And then real estate, obviously as an inflation hedge as well. So we've just never been boxed in to say this is the only way to do it. This is the only, they all work as long as you utilize them correctly.
Yeah, they all work and they all, this thing might perform better this year, that thing next year, it just goes back to the most common word you hear in finance or investments, I should say, diversification.
Yes.
Diversify.
I like risk management better, because look, a lot of our clients are not that diversified. They have 70% of most of their household net worth is wrapped up in their
practice
building and their practice. Yep. They're not that diversified.
No.
Right. But, and they shouldn't be. If you want to have a 8 to 10 to 12 to $15 million net worth, you can't S&P 500 index your way into that. As much as I know you want to, Gersch, you can't. You
got to have a lot of money to get there doing that.
Exactly. Yeah. Okay. And so you have to take a risk someplace. Yeah. In that vein. But so
take that risk somewhere you control, or at least you have some control of the outcome.
Yes.
With your practice. How much control do you have over whether the S&P grows or falls this year? None.
So,
at all.
But you have control over the practice. And from what these values are telling me, that's not really going away. So you have a good practice nowadays that can sell for 7 to 8 times multiple.
Oh, easy. Yeah.
Which is incredible.
Yeah.
If you get a practice that's doing $500,000 in earnings, you can sell that for what, $3.5 to $4 million.
Yeah, probably 3 to 5 million, realistically.
And in some of these industries, it's even more. I'm not even going to use some of the 18 to 19 multiples. I think those are going away.
Yeah, they are.
They've had their day.
Yeah, I'm already seeing those kind of shrink. So stay away from that.
They have had their day, but people still can make a tremendous amount of money in their business.
Yeah.
By focusing on that. And so I think that's a place that you would invest. But at the same time, you really have to look at the other assets that you have. Do you want the stress of loss?
Yeah, you got to be able to stomach it.
And most people are just like, no, not really, not right now. And so anyway, I think that's just part and parcel of the risk management approach that I think needs to come back. Because it hasn't.
Yeah.
It's like every dollar that I get a hold of, I need to put somewhere that's going to make me more money. Like I just hear that. I just want to put my money in place that's going to make me more money. That's it.
Yep.
That's someone that's running scarcity on money. That's someone that doesn't have a business that's producing enough revenue for themselves. Because if you have that obsessive impulse to do that, that just tells me that you're struggling somewhere.
Yeah, there's nothing wrong with an emergency fund.
No. What's wrong with having a couple $100,000 just sitting in your emergency account?
Nothing.
It doesn't have to like be put into something that's gonna, triple in value.
Yeah.
That I think that's a misnomer. So, okay. Well, I think we accomplished a lot right there, didn't we?
Yeah. I feel like we covered it all.
We did cover a lot. So this is an episode that, we thought was important and timely. And, if you have any questions as far as what we do, then you can always go to our website, Econologics.com,
Econologics Financial Advisors.com.
You can actually do both if you want to.
Oh.
You didn't know that, did you?
Did not know that.
That's okay. And we have all kinds of tools and assessments and everything else that can make your life easier and put you guys on track towards creating the financial life that you desire and you always thought was possible. So definitely take some action right now. If you get this podcast, share it with everybody else because we want to try to grow this channel and this podcast so that we can reach as many practice owners as we possibly can. I think that's it.
Sounds good.
All right. We'll see you next time.
Bye.
You have been listening to the Financial Beast podcast, where we talk about how to turn practice profits into personal financial wealth. For more information on how to become a financial beast and practice ownership, visit financialbeastpodcast.com. You may also want to call the office at 727-588-1540 to request more information on becoming a client or arrange to have Eric speak at your next event. That's 727-588-1540 or financialbeastpodcast.com.